government student loan deferral program is going to end this September, and I want to share with you very important information to make sure it doesn't impact your ability to buy a home, whether you're an existing homeowner or you're a first-time home buyer. So the first thing I want to address is credit, and this can impact you in there's two categories of people. Number one, if you have the student loan, and number two, if you're a co-signer on the student loan. For both of you, this is important. I think it's particularly important that you pay attention if you're a co-signer, because you're just hoping that the primary obligor or your kiddo that you co-sign for is going to take the correct action when the deferral's up. If you do not put the student loans into either a payment plan or get approved for another 6-month deferral, then these will go into default, and you'll have a 30, 60, 90, 120 day, 150 day, and potentially even a collection on your credit. And what that'll do, the collection will impact your ability to get a mortgage because it has to be accounted for. But the biggest thing is that it's going to impact your score. So there's a very easy way to solve this. So to solve this is, number one, is an additional deferral. You have to call the servicer, and you have to qualify. It's pretty easy to get a deferral. You can pretty much kick these things down the road 6 months at a time in perpetuity. But that would be one option. That's not your best option. So as an advisor, as a certified mortgage planner, somebody that looks at the results of people's actions, because I see all their finances for the last 20 years, the worst thing you can do is a perpetual deferral, because what you have is a growing asset and liability on your balance sheet that way. It just gets worse and worse. So we want to look at a payment plan. So there's 4 different kind of payment plans you can go into, and that's graduated, extended, standard, income-based. So let's first talk about the standard. Standard is typically a 10 to 15 year repayment. It's usually 10 years. And one of the problems is for students or for people that have not been used to making payments, this is probably the best option because it's the shortest term in terms of the interest paid. But from a cash flow perspective, it has the most impact on because it has a higher payment. So people tend to just blow this off. The other options are extended. This is one where you can typically go out to 25 years. Graduated is where you start at one level and then it slowly goes up like stair steps. And there's an income-based, and an income-based is based on your income, and it's a percentage of your disposable income that gets applied to the loan. So let's talk about each of these real quick. And for the two that I would say I would focus on. Number one, the extended plan is a good option. Let me back up. The standard plan is a good option if it sort of fits in your debt ratio. I would not do the standard plan at the expense of buying a house. There will be many people that tell you in good faith that you don't want to pay that interest, but they've never done the math. Home ownership and levels of appreciation of 4% or more, which is the next 3-year average that's anticipated, or 11%, which is the last 30 years, will far outpace building your net worth than waiting 5 years or 6 years and trying to knock your student loan debts out. You should do both. Put the student loans into an extended payment plan if you can. That way you're making a payment on them. It's going to be going down each month. It's not growing anymore, and you're making somewhat of a principal payment, and then buy the house. Because I've done other videos where you can literally buy at first. If you're a first-time home buyer, if you're a parent thinking like, hey, I can help my kid out, you want to pay off your student loan, buy a house, sell it in 5 years, using that proceeds. Most of you will be able to pay your student loan debt off just like that, and then you can go back in and do a small down payment and buy another house and rebuild it again. And that's just one example. But the bottom line is an extended payment plan does make that principal payment, so you at least are starting to retire the balance. The other option that's not so bad is if that's not an option at all, any kind of large payment or even an extended payment, the income-based approach is not so bad because at least you're paying something towards interest. It's more like a negative amortization loan where you're making a small payment based on your income, and then what happens is that if it doesn't cover the entire interest payment, the loan balance still grows. But imagine if it's growing at a rate that'll double every 8 years, and you can turn that into where it only doubles every 30 years or something like that. That's a huge win. So those are the two options. So the big takeaways are, number one, if you have student loans, get it on your calendar for really like August, probably like August 15th, August 20th, right around there, that you're going to call the servicers and find out what your options are and work out a plan, either defer for 6 months if needed or do a repayment option standard, extended, or income based on your situation. If you have any questions, let me know, and I hope you found this helpful.